There must be something to the life insurance story just by the observation if I'm a consumer. But we know the difference, and it's you've got to get into the details. You got to get into the differences between the taxes, and you got to get into the differences of the fee drags. And there are probably some life insurance policies today that are being sold that shouldn't.
Yeah.
And there's probably some policies not being sold that should. Yeah. And there's always going to be those truth gatherers and those evil ones that share information that's not right. But authentically, those that should have life insurance combined with annuities and traditional investing, nothing fixes or creates an opportunity for those consumers, those clients, better than the combination of those products when properly positioned.
I love it. You've said a couple times, chasing alpha, buying income.
Buy income, chase alpha.
Buy income, chase alpha. Is that your framework on how you help people?
When you buy income, chase alpha, it frees the hostages. Let me give you an example. 4% rule.
Yes.
Got $1 million. Been saved my whole life. Me and my wife put our 401k together, rolled it to an IRA. We got $1 million. Let's say it's just because I got the math here. Let's say it's 3%, $30,000 for $1 million, right? That's 3% rule. You can convert it to 4 if you want. But let's say I need $90,000 of income.
That's $3 million.
Well, no, I've got $30,000 pension. I'm lucky enough to have a pension.
Great.
I have $30,000 Social Security between me and my wife. I got a whole $30,000, and if I need 100, I've got a whole of 40,000, right? Well, if I got $1 million and I'm going to adhere to the 3 or 4% rule, how much free liquidity do I have when I retire? The answer is 0. Why? Because I have to hold hostage that $1 million. I can't spend one more dollar without taking a higher risk of withdrawal drag. And if the market misbehaves in the red zone, that first 10 years of retirement, I'm on a slippery slope to 0 really fast with longevity. Who knows how long it may last? And so I can't touch a penny of that. I'm held hostage with a gun to my head on the performance of that money for next year's safe withdrawal. Now, if I have $2 million, now I have $1 million of free liquidity. I literally have unfettered assets to go to the casino, give to charity, pass to my kids, buy life insurance, take long-term care risk off, chase alpha as risky as I wanted to be. I now have free liquidity to do it. But till I buy income to free hostages, dollar hostage in my portfolio, I can't chase alpha. I have to constrain for a safe withdrawal rate until I approach the day of retirement. And it cuts me off at the head.
I love it. So you're figure out what that income number is. Figure out that income number, I would assume, with as few dollars as possible. And then everything else, you can chase alpha, you have liquidity, you have opportunity.
Yeah. So I'll give you 2 examples of my own products. And you can do the math. So in 2009, I bought a 5-year bridge of income. I'm 45. I realized over my years of research as an academic that usually in a traditional interest rate environment, the earlier I buy, the higher the IRR for the bridge. And so I tested this, 5 years out, 6 years out, 10 years out, 12 years. I went all the way to the 20th year. And every year I delayed up to the 20th year, I got an incremental increase to the IRR, the internal rate of return. When I went to the 21st year, it was either negligible or not at all. And so I realized that the insurance manufacturers, by and large, know how to price performance up to the 20th year deferral, but they have no idea how to bet on it after that. So my rule of thumb is never buy income more than 20 years in advance. Most will never going to do it anyway. Most are going to do it 5, 10 years ahead of time. But 20 is... I'm an extremist, so I did it. You know why? Because I got a 7.34% IRR with no fee drag on money that I needed for a 5-year bridge. I put in $50,000. In 20 years, I get 5 years of payments for $50,000. I get $250,000. The IRR was posted actually on the Prudential quote. I got a 7.34% with a 21% exclusion. 21% efficiency to tax, and I'm pulling money from my fixed allocation of my portfolio to lock this in. So I actually got about a 2.4% increase to my performance over what I was going to get negative fee drag on my fixed allocation in the market at risk. That's one example. And so these products are not inferior, right? If I die, because I did installment or cash refund or in a period certain, my heirs get all the deposit and they get all the gains on the period certain. But then I did another one.